Hi everyone, this is Shweta, founder of the Financial Book. In our previous video, we had discussed what is equity and how does equity market work. And now we'll proceed further on the same topic and I'm going to tell you how can you derive benefits from the equity shares. Let's recapitulate first what we learned in the previous video. Let's start with what is equity. Equity is the ownership right in a company. The total capital of the company is distributed into number of shares having the same face value. Just imagine a cake having equal pieces. Now, each piece is like a share. If you want, you can buy one, two, or five, whatever number you want. You can invest in the company firstly when the company is making initial public offering or when the shares are being traded on the stock exchange. It's upon you and your choice. I hope you got the overview of equity share market. Now let's start with the benefits you can derive from equities. The first benefit is dividend. Just like any owner, the equity shareholders also have the right over the profit. Here, the company distributes a certain percentage of profit among the shareholders. This share of profit is called dividend. Infosys on 25th of October 2018 had declared a dividend of 7 rupees per share. It means if you had 100 shares of Infosys, you could earn 700 rupees at a time. The second benefit is capital gain. This is the reason why investors try to enter this equity market. Price of the shares are not always stagnant. Those are volatile in nature. The main factor behind this is buying and selling pressure. When there are more buyers in the stock market for a particular share, the price of that share goes up. And on the other hand, when there is a selling pressure, the price goes down. So, when you sell the shares at a price which is higher than your purchase price, you have capital gains. I can simplify this capital gain matter for you. For example, in November 2018, during the last week, Z Entertainment was trading at a price of 460 to 468 on Monday and Tuesday. But later on, it reached 496 rupees at the end of the week. So, this gap is where the investors are interested. When you are buying the shares at a price of 470 rupees and you're bullish on the share, after that, if you sell it off at rupees 490, this 20 rupees gap is your capital gain. The next benefit is bonus shares. When the company announces issue of equity shares to its existing shareholders without asking for a single penny, it is called bonus issue. It means you are not going to pay anything, but you're still getting the shares on behalf of your own existing shares. The ratio is decided by the company itself. The ratio sometimes it is 1 is to 1 or 2 is to 1. On 19th April 2018, TCS announced a bonus of 1 is to 1, which meant if you have 10 shares of TCS, you could get bonus of 10 shares at that time. And the fourth benefit is right issue. The company comes with a proposal to its existing shareholders that they can buy the equity shares of company at a concessional rate, which means, for example, if the shares are trading at a price of 100 rupees per share in the market, the company can propose to the investors for purchasing those shares at 95 rupees per share, which will be profitable for the investor. Now it's upon the investor if they want to invest at that rate or not. Tata Steel on 31st January 2018 had announced right issue at a ratio of 2 is to 25, which meant 25 shares owner could get 2 right shares, yani 2 right issues at a price of 605 rupees. On 31st January 2018 only, the price of Tata Steel ranged from 748 to 705. Let me tell you that I have no personal interest in any of the companies which I have given you as an example, and do your own analysis whenever you want to start investing in the equity shares because investments are subject to market risk. Till then, please like and comment on the video and share it with your friends and family and subscribe to the channel. Please press the bell icon as well, because we'll be right back with much more interesting facts about the financial market.